we just saw how increasing shareholders' wealth is the most important one to consider while planning the debt and equity mix in your capital. Now let's discuss what are the other things that you should be considering before deciding about the capital structure. The first thing you have to be considering is the cash balance in your bank. Interest and repayments are going to be obligatory on your part. You have to be paying it no matter whether you make profit or loss. And so you have to be mindful of total obligatory cash outflows that you are required to make if you increase the debt in your capital. So while deciding this, what you should be ideally looking for is that you must be left with a good amount of profits, and then you have to be left with a good amount of cash balance. So these are the two things which you have to be focusing on. We should have comfortable profits and cash balance after paying interest and also after repaying the loan. The next thing we should be looking for is the interest coverage ratio. This refers to the number of times you could cover the interest obligation. This is calculated as follows. Interest coverage ratio is EBIT, earnings before interest and taxes, divided by interest. Let's work out this example to see how it works. So interest coverage ratio is EBIT by interest. So EBIT in example 1 is 50,000 and the interest is 25,000. So 50,000 divided by 25,000 we get 2. So this means that you have adequate profits. You have 50,000 rupees of profits and you just have 25,000 rupees of interest. So you will be able to comfortably cover and pay interest of 25,000. That's what we are looking at. So we have enough profits to pay interest. We have 2 times the profit when compared to the interest. So 2 times is the ideal ratio. So that means interest coverage ratio is good. And in example 2, we have 25,000 rupees as profit and 50,000 rupees as interest. So we will be making a loss if we pay this interest. The ratio is 0.5, which is very poor. So the ideal ratio should be 2 and anything more than 2 should be fine. Also, if this ratio is good, it does not mean that you are good to go. You also want to ensure that you have adequate cash balance, as this involves that cash outflow that will be debited to your company's bank account. So you want to ensure that you have adequate cash balance at bank. So what you also do here is you also compute your cash profits in addition to determining your interest coverage ratio. Now, if you take any P&L, it's going to have depreciation and other non-cash expenses like amortization, unrealized gains and losses, etc. So what you're going to do is you're going to eliminate those non-cash items which do not involve any cash inflow or outflow from the profits. And you have to find out your operating income for this. Your net operating income should be able to cover the following. It should be able to cover the interest, it should be able to cover the preference dividend, and it should be able to cover the repayment obligation that you have. So for this purpose, we are computing the debt service coverage ratio. In debt service coverage ratio, what we'll be checking is, we will be checking if we have enough profits to not only cover interest, but also cover the preference dividend, which is a mandatory payment again, and then all repayment obligations, all debt obligations or loan obligations that has to be repaid. So we're going to check if we have enough profits to pay this. So for doing that, we add back depreciation, or we only consider the operating profit, which does not include depreciation, which does not include interest, and which does not include any taxes. So we have to be taking that profit to see if it is good enough to cover the interest, preference dividend, and repayment obligation. So here in this example, we have loan of 50,000 rupees, interest of 5,000 rupees, and EBITDA of 125,000 rupees or 1,25,000 rupees. So we compute the debt service coverage ratio, which is EBITDA 125,000 rupees divided by 55,000 rupees, and we get 2.273. So it's 2 times more than all the obligations, mandatory obligations that you have to be meeting in terms of cash. So this is good. This ratio is good. In example 2, we have an EBITDA of 90,000 rupees and we have the mandatory payments of 55,000 rupees. So this comes to 1.636, which means that it is not so good. It's on the poorer side. So the second ratio that we should be looking for is the debt service coverage ratio, and it should be more than 2 to be in a comfortable position. The next thing we would want to know about is the return we are currently getting on our investments. We've already seen this in our capital structure planning, where we saw that EPS kept increasing here when you increase the amount of debt in your capital. And this was because the ROI was 13%, which is 3% more than the cost of debt, which was 10%. And your EPS started decreasing because ROI was lesser than the cost of debt. So ROI is one important thing that we should be calculating to decide about the right mix of debt and equity. Next, cost of debt is the percentage of interest that you will be paying on the amount you borrowed. So in our previous example, we saw Z Mobile raised a debt with 10% interest, which means that the cost of debt is 10%. So cost of debt is nothing but the interest percentage that you are paying on your debt. Now, cost of debt is the extra money you pay to borrow money from someone. And so it's another important thing that you should be looking for to decide about the mix. If the cost of debt is lower, you could get more debt. And if it is higher, you might have to borrow less because you will end up paying more interest. So in this case, we have 3 options. In the first option, the cost of debt is 10%. That means you have to be paying 10% interest. And in the second option, we have cost of debt as 12%, which means you have to be paying 12% interest. And then in our third option, we have 8%, which means you have to be paying 8% interest. So which one would you choose? You'll obviously choose the third one, the last one, because it has the lowest cost of debt. You'll be paying just 8% of interest for the same amount of money you borrowed. So obviously you will end up choosing the third option. So cost of debt is one more factor which you should be considering before deciding on the debt and equity mix. The next thing you should be looking for is the cost of equity. Stock owners generally expect a rate of return from equity, and this expectation will be equal to the risk they are assuming. So in case if you keep increasing the debt in your capital, which means this increases the financial risk, and so the shareholders will expect a higher return. This is because they are taking more risk by investing in your company, which is more debt. So for this reason, companies cannot use debt beyond a point. Now, in order to maximize the shareholders' wealth, you have to use debt optimally. And that's what we are showing here. If there is a higher risk, the shareholders expect a higher return for the risk they are taking. So the risk increases if the debt increases in your capital, because that becomes mandatory for you to repay the loan and also to pay the interest. Next, what we should be looking for is the flotation cost. Flotation cost is the cost you incur in the process of raising capital for your company. These are costs like legal fees, audit fees, and fees paid to stock exchanges to list your shares, among others. It's something similar to the brokerage you pay when you buy a house or rent a house. So flotation costs generally tend to be lower when you borrow money from a bank, and it tends to be higher when you raise money by issuing shares and debentures. Now, this does not mean that you should choose an option with low flotation cost, but what we are trying to drive here is that you must also have an eye on the flotation cost and consider it for making your decisions. So this is one kind of cost you incur in order to obtain money, and so you would need to calculate the flotation cost before deciding on the borrowing option. Next thing we should be considering is the control. Control is an important aspect. If you raise equity, it means that you're ready to share the ownership with those who have invested in your equity shares. So the percentage of their ownership plays an important role in determining their control over your company. As the percentage increases, their control over your company also increases, and they start participating in your decisions and influencing your decisions, for which you cannot sometimes say no. So this is the flip side of raising more equity shares and sharing ownerships. So you need to have a check on the control aspects too. The next factor you should be considering is the regulatory framework. There are certain regulatory framework within which each company operates. For example, public issue of shares and debentures have to be made as per SEBI guidelines in India. SEBI is Securities Exchange Board of India. And in the United States, you have SEC, Securities Exchange Commission. In whichever country you are in, there will be regulatory bodies like this and will have their own regulatory framework. So you have to comply with the regulatory requirements if you want to make public issue of shares and debentures in these countries. Now, alternatively, if you want to approach a bank or a financial institution, even then you have to be fulfilling few criteria in order to be eligible for the loan. So you have to make sure if your company is fulfilling or complying with the requirements before raising money. The next thing you look for is the stock market conditions. If the stock market is bullish, which means it is doing good and many people are buying shares, so you can sell your share easily at a higher price if the market is bullish. On the other hand, if the stock market is bearish, which means it is not doing good, and people are selling shares in the market, so in this situation, you may not find buyers for your shares. So it's difficult to raise equity. And so in these situations, you have to raise a debt. Now, apart from the factors discussed above, you could also get a good idea about how you should structure your capital by looking at the capital structure of other companies in your same industry. For example, if you're in the food and beverages industry, you should be looking for a similar company in the same industry to get an idea of how their capital structure is. And then there will be an industry norm, so you can also adopt the industry norm. So far we have seen about 11 factors that are to be considered before deciding on your capital structure. Let's summarize these now. The first thing we should be considering before deciding on the capital structure is the cash flow or the cash balance that we have in our bank account. And then we should be calculating the interest coverage ratio to determine if we have enough profits to cover the fixed interest payments. The next ratio we should be calculating is the debt service coverage ratio to find out if we have enough cash profits, the profits arrived before considering the interest, depreciation, and taxes. So we should be knowing if we have enough cash profits to cover fixed payments like interest, loan repayments, and preference dividend. So this is also an important ratio like the interest coverage ratio, and the ideal ratio is 2. The other thing we should be considering is the return on investments, whether the return that we are earning on our investments is more than the cost of debt. And then we have to be considering the cost of debt itself. If we have 3 or more options, we might have to go for an option which has a lesser cost of debt, that is lesser percentage of interest. And then we have to be considering the cost of equity. What are the expectations of the shareholder? Are they expecting more returns or are they expecting nominal returns? That's what we should be considering before deciding on the financing options. And then we should be looking for the flotation cost. These costs are costs like legal fees, audit fees, or fees paid to stock exchanges. And then we have to be looking at the control. So if we have to raise equity, how much of control should we be giving to the equity shareholders to participate and influence our decisions? And then we have to be looking at the regulatory framework in which our company is operating. And then we have to look at the stock market conditions. If it is bearish, that means people are selling shares and we'll have tough time finding buyers. In case if the stock market is bullish, that means people are buying shares, we'll be able to find buyers easily. The last thing that we should be considering is how other companies in the same industry have structured their capital, and this will give us some clue on how we should also be structuring our capital. So these are the 11 important things that we should be considering before deciding on our financing options.